Welcome to this week market dashboard where, if you look at the variations over the week, you could think that not much happened. So let's take a look at what the market did this week. So you see that the S&P didn't move much, slightly down for the week. Bonds slightly up for the week. US dollar nearly, slightly up, nearly flat as well, which is surprising considering the geopolitical turmoil currently in the Middle East. The equities didn't react, bonds didn't react. As a safe asset, we've seen many times the issue with bond being considered as a safe asset. There's no rush to the US dollar, which can also be considered as a safe place for assets around the world. Even Bitcoin, didn't move much. It's down a little more than 1% for the week, which, considering the volatility of Bitcoin, is non-significant. I think the only thing that we can actually note about the performances this week is the variations of gold and oil. You have gold that is down about 2%, just like nothing happens. Again, no rush to a safety asset at this time. On the opposite, the oil is telling a different story because it was rising more than 3% over the week. We've seen, higher variations of oil recently, but gold and oil variations gives a contradiction of where the Middle East is standing at this time. Again, gold, not, no rush to safe asset, and at the same time oil running high because of potential threat of the closure of the Strait of Hormuz, which would have a very significant impact on the oil market. And basically that's about it for the market this week. Again, it really looks like nothing much happened. The VIX itself didn't move much. Of course, it did spike on the first attack of Israel and then stayed where it is at this time. So no excessive, panic, at least in the equity markets. Again, I wanted to show you oil. We had oil rising in 2022 when we had bonds going down, interest rates going up, and equities going down as well, which led to rebalancing of assets towards commodities. But since then, the situation is normalizing, I would say, for oil, going back to a price where basically it should be. There's no shortage of oil in the world. The only impact going forward would be, again, the conflict in the Middle East and the blockage of the Strait of Hormuz, which is reflected in the price of oil. But again, that's about it. Now, again, is the same thing in terms of activity on the market. If we look at the activity indicators, they are all flat or going down. The only one going up over the past weeks is oil. This seems to be the same, the only asset where something happens at this time. And again, you would never think that we are on the verge of World War III, and if I can find only one reason, one chart where we could see that maybe something might be concerning, is bonds versus US bonds versus US equities. They are usually naturally, so this spread is naturally going down. It spikes in terms of crisis when there's a rush towards safer assets, just like in 2020. Here, the first spike is for COVID. Then we didn't have a spike in 2022 because of the debt that was weighing both on bonds and equities. So bonds were not a safe asset at this time. We've seen that bonds is not really a safe asset anymore, but still bonds are not going down anymore versus the S&P. which means that basically investors don't know where to go either between equities, bonds, or potentially something else. And the else could be gold. We've seen rising over the past year, specifically since the beginning of this year. But at this time, gold is not doing anything anymore. So which means that investors are in a period of, it's a waiting game at this time to see where we are going in terms of fiscal policy. I think we already know, since Trump's big beautiful bill or something like this passed, because the deficit will keep increasing again. So this is not good for interest rates and inflation. And obviously the conflict in the Middle East. So, the conflict in the Middle East is probably what's locking the market at this time. Nobody knows about the involvement or not of the US in the conflict. Trump has been blowing cold and hot on this, saying that he will bomb Iran, and the next day he says that he will find a peace agreement, negotiations and a peace agreement with Iran. So again, there's nothing, people are lost basically at this time, kind of. So I wanted to, so it's a small one today. So I wanted to show you a couple of things that might be interesting for you. You know that most funds are weighting their assets based on risk. The higher the risk, the lower the exposure to a specific asset. And one way that CTAs, commodity trading advisors, do that is by weighting their instruments in their portfolio based on the inverse of volatility. The higher the volatility, the higher the risk, the lower the exposure to that specific asset, so that all components of their portfolio bear basically nearly the same risk. And so what I'm showing you right here is the theoretical exposure of a fund that would invest in bonds, gold, and equities based on volatility. So you see that so the weight of equities significantly dropped since the beginning of March, with the heightened risk and the drop in March and early April. So now the market is quieting down. So this is why the exposure on equities is rising again. That's the arrow at the bottom. Gold, which is posing is again have a lower volatility, which means that the theoretical exposure is increasing as well. And on the opposite, the volatility on the bonds is slightly increasing, and this is why you see recently the drop in exposure for bonds. So again, I want to repeat that this is an example of the way commodity trading advisor, at least some of them, are weighting their asset in their portfolio as an inverse of the volatility representing the risk. The objective is, again, to have all the components of the portfolio bearing about the same risk. So that you have a well-diversified portfolio that is not overweighted to a single asset that would dominate the risk and the performance of this portfolio. Again, the idea is to kind of maximize the diversification. Not exactly, but I don't want to go into details. So, and I basically did the same exercise. So this is the weighting based on a fund that would target 10% volatility of each asset. So this is why you see sometimes, for instance, when volatility was pretty low in June 2024, the weight was 120%. So this means that you can have leverage in this kind of circumstances, and if you get the total, it would be probably nearly, let's say 300, so 3 times leverage, so which most people would not do anyway. But again, this is an example. It is not a real situation. But this doesn't mean that the portfolio would be as risky as 3 times the S&P just because of diversification again. So you can convert this into something that is an asset allocation system where all the weights sum up to 1. And basically that's the kind of exercise that I did here, where I also introduced Bitcoin within the picture. So these are the weights for a theoretical asset allocation system based on volatility or inverse volatility to weight the risk within the portfolio. And the point I wanted to make is just to show you how this the allocation would evolve over time. But the point I wanted to make by introducing Bitcoin in this one is that you see the Bitcoin allocation going up on this example in terms of risk to slightly less than 20%, which would seem very big at this time for most of you. But what this indicates is that with the institutionalization of Bitcoin, that's hard to say for me, the volatility of Bitcoin or IBIT or whatever you may choose as a vehicle for Bitcoin exposure has gone down pretty drastically. And as the risk goes down, obviously the strategies that are implementing risk parity schemes, procedures like this one, will see exposure in Bitcoin rising naturally. So next, someone asked me this week in my DMs on LinkedIn about what I was thinking about bonds. Well, bonds at this time, you see, it's been pretty ugly since 2020, massive injection of liquidity in the markets, which triggers inflation. So rates increasing and then bonds going down. So that's naturally what's happening. Today we have kind of reached a bottom at this point, specifically considering the situation in the Middle East. That can be seen as positive for bonds. But at the same time, you have the big beautiful bill that is continuing this government spending, which weighs on inflation and interest rates. And you have one side that may be pulling bonds up and another side that is pulling bonds down. And so we are in this kind of situation where it's kind of not going anywhere. So I won't give you my position on bonds at this time, but the main issue for bonds, specifically very long term, is the US government deficit. And as long as this is not fixed, it will be difficult. This will always act as a pressure on the price of bonds. That's what I want to say. Maybe one last thing about equities and bonds. This is the S&P and long-term bonds rolling correlation. And what you see here is basically why the 60-40 and the risk parity, such as the one that I've shown you before, strategies broke down specifically in 2022. We went from a situation where the correlation between equities and bonds was mostly negative, to a regime where now the correlation spend most of the time in on the positive side, which means that you don't get the diversification that you would expect from bonds with equities. And in the context where inflation is rising, you don't have diversification between equities and bonds, and you have bonds going down because of deficit spending. So that's what we've seen over the last 4 years now. obviously this totally breaks down the 60-40 portfolio, and if the deficit is not fixed and the correlation stays like this, there's no way that the 60-40 portfolio or even a risk parity equities bonds portfolio will be able to come back, or give decent returns, at least to overcome inflation. So thank you very much for sticking with me up to now, and I wish you a great weekend, and I hope to see you next week. Bye bye.